This is the first seminar this academic year, 2021-2022 academic year. And we are fortunate to have there's actually a group of 3 authors who've put together exciting work with an exciting title, Neither True Friend nor Fairweather Friend, Relationship Banking and SME Borrowing under COVID-19. Absolutely exciting, both in title and also in addressing a contemporary issue and placing it within economics, banking, and finance. And the paper will be presented by Tianshu Zhao. Tianshu is very well known within the Center for Global Finance and Network, and was indeed a co-investigator in the Inclusive Finance Research Project. She's an applied microeconomist based at University of Birmingham, Birmingham Business School, and works mainly in exploiting the microeconomic foundations of finance and growth, and especially with applications to the banking sector. The co-authors, we are fortunate that we have the co-authors here. We have in particular Professor Kent Matthews, who is Julian Hodge, a professor of banking and finance at Cardiff Business School. And again, Kent has been active in the Center for Global Finance seminars, having presented a seminar here some time back, and is a very established name in the area of banking and finance. You've seen a little bit of the bios for both Tianshu and Kent. There is also a third co-author, Professor Max Munday, who is the director of the Welsh Economy Research Unit at Cardiff Business School, and I've had the pleasure of working with both Tianshu, Kent, as well as Max. I'm not sure whether Max is around, but maybe not. He's now working on a very active 5-year program of research with the Development Bank of Wales, to which actually also both Tianshu and Kent have contributed to the blueprint studies for the Development Bank of Wales. So Tianshu, I'll give you can speak for up to an hour, and maybe, virtual presentations are unique in many ways because possibly the interactive element may not be effective. But of course, if anybody has any question or comment as Tianshu goes, you can flag up using one of the indicators of raise the hand in the panel, and we take it from there. If not, I will pick up the questions after Tianshu's presentation. In terms of housekeeping, let me say, please, yes, you have a question, cool?
No, just out of respect to everybody, I'm saying we have got a section meeting, so in 35-40 minutes, I shall be disappearing. So please don't feel disrespectful, okay?
Okay. No, that,
we have
thank you very much. We take that in mind. If you walk after 20, we will not take it as an offense that it's about what Tianshu is saying. It's about the other time constraints you have at the moment. Okay, so let me also welcome some other, distinguished people. I can see, Grace Chokunda from the African Orient Bank. I can see Jojo Hero from Makerere University. Quite a number of experts. I can see Sandra Akendo. Thank you very much for coming. Now I think we should start immediately. Tianshu, I guess you are ready, and maybe, I don't know whether Kent is going to be speaking, but maybe you can be free to join the Kent as you wish, if you want to. Okay, Tianshu, you are most welcome. Please go ahead and start the presentation. Thank you.
Okay, thank you very much for the kind invitation and kind introduction. As you can see, here is an interesting title. The paper actually is very short. Also, it's a very recent paper. We finished the paper like around July. So let me see, let us have a look what we have done and what we have found. So first of all, I want to introduce the background of this research. As we all know, asymmetric information is a major feature in the financial market, and therefore there is a market failure in the financial market. Such a problem will be particularly pronounced for small and medium firms because compared to big corporates, big corporations, small media firm has no historical record, very long historical record, has a limited capacity to apply the collateral to bridge informational gap. Indeed, a majority of their information is soft by its very nature because of shortage of those hard information. As a result, they suffer from a high difficulty in terms of getting access to bank finance, to external finance, generally speaking. So literature highlight one way to get around this problem, informational problem, is to provide relationship banking. Relationship banking takes into account soft information, which is intangible information regarding the creditworthiness of SMEs, which could act as enabling mechanism to
just
handle.
one quick question, Tianshu. Sorry to interrupt. Are you sharing PowerPoints?
Yes, I am.
We can't see them. Thank you. Yeah.
So
yeah.
I already said asymmetric information problem, particularly pronounced for small media firms. If lending decision is only based on hard information, small media firms are not able to get access to external finance. As a result, the literature highlights the importance of using relationship banking to bridge such information gap. Essentially, relationship banking takes into account soft information SME firms has, and then based the analysis of creditworthiness of small media firms on such soft information. As a result, relationship banking enables the market and bridge information gap, which is not able to be done through the normal market mechanism. So the literature highlight small media firms, if they have closer relationship with banks, they would have better access to bank finance. This is about extensive margin. Also, they could receive favorable treatment in terms of condition if they could get access to external finance. This is intensive margin because banks are willing to supply credit based on relationship banking, taking into account the private information during the duration of relationship with the small media firms. However, the literature also highlight relationship banking could also incur cost facing by small media firms. The reason for this is because very stronger relationship with the bank with whom small media firm have actually could lead to informational catch up. Informational capture and allow the bank to exercise, market power to extract the informational rent. This is what we call as informational hold up problem. Okay, this is called the dark side of relationship banking. So when we look at the empirical literature, research on the effect of relationship, on access to bank finance for SME is related is relatively limited. The paper by Bolton theoretically indicate banks may protect relationship borrower during the crisis time. Okay. However, the paper also indicate, even banks could protect relationship borrower during the crisis. Borrower may need to pay kind of premium to receive such, protection during the crisis. Okay, and the research on the relationship lending during the global financial crisis period most support the beneficial impact of a relationship, i.e. having a stronger relationship could enable small medium firms to get access to the bank finance during the financial crisis period. We look at this situation regarding the COVID-19 shock because COVID-19 shock provide ideal experiment setting allowed to have examination on the value of relationship banking, when borrowing firm are in need. This is a very ideal situation because the COVID-19 shock is exogenous for banking system plus borrowing firm. In addition to this, different from financial crisis, this shock is not originated from the banking system, but a kind of a shock toward the real economy. Okay, so when we look at the literature, we found some literature have done the empirical examination to look at the value of relationship banking on access to bank finance and the terms and the condition whenever there is access. Generally speaking, paper with respect to US and other international, empirical settings suggest there is dark impact or negative impact of having a closer relationship with the bank on the access to bank finance as far as the COVID-19 period is concerned. Okay, so what we are going to do is we are going to visit this topic using the UK experience, small medium firms experience to get access to bank finance. We are particularly look at three-dimensional heterogeneity. We look at the strength of relationship. We also look at the size impact and the industry impact to be specific. We first ask whether small medium firms with a relatively closer relationship with the main bank has a higher likelihood of getting access to bank finance. We further look at the variation in terms of this value. We compare the value toward small firm versus larger firm, small and medium firm, because we look at the small and medium firm as a population. So secondly, we ask, does the impact of closer relationship with the bank appear to be different when we look at the post-COVID-19 period compared to pre-COVID-19 period? We further to ask whether the change in the impact different for the small firm versus medium firm. Thirdly, we ask whether the impact appear to be stronger or weaker for the small medium firms if those firms operating in industry suffering larger negative shock in the COVID-19 period. Okay. So as far as the data is concerned, we use UK SME Finance Monitor. The data is between second quarter 2018 to third quarter 2020. Okay, so if you are familiar with this data set, actually the data run by quarterly on the quarterly basis to ask SMEs experience to get access to bank finance and all kinds of external finance. Its experience is for the past 12 months. the survey done on the quarterly basis. Also, all the small media firms to be included in the survey actually refer to those who are not non-profit organization, and also only for the firm who has turnover below 25 million British pound. So we first generate a post dummy, which is a dummy variable, take a value of 1 for loan application made in 2020 first quarter onwards, and 0 after, 0 otherwise. Basically, we separate the sample period into pre and post COVID-19. We generate a second dummy variable, which indicate small firms versus media firms. We take the definition of EU definition. So if the firm satisfy, 2 conditions, one is a turnover smaller than 75 million euro, 75 million British pound, and also a second condition, number of employees smaller than 50, we treat it as a small firm, and otherwise treat it as a media firm. So in addition to this, we generate another dummy variable, which based on industry-specific index of first-order reduction in output from the COVID-19 shock. We actually get the information from paper done by Pitcher. The index is very interesting because the index actually consider both the supply side shock and the demand shock, and also the index is at the industry level. As far as the supply shock is concerned, it considers, the difficulty of different industry to be able to work at home. In addition to this, consider the propagation of shock from upstream and downstream industry in terms of supply chain. Okay, because any production process need input materials, otherwise production is not possible. So not only consider such supply shock, i.e. the production capacity, but also consider demand shock. Demand shock refer to customers' preference change because customer develop concern regarding the likelihood to get affected during the COVID-19 period. Okay, we take into account these 2 measures, then we actually use the maximum of supply plus demand, because this value will give us the shock facing by different industry in terms of generating cash flow and revenues. Okay, so it's going to take a value of 1 for industry having a value higher than the media and 0 otherwise. Okay, so what we are trying to catch here is industry-specific shock in terms of generating revenue and cash flow. Okay, so as far as the access to bank finance is concerned, actually this is our dependent variable. We only look at the new bank credit, including bank loans and bank overdraft borrowing from their main bank. Okay, so as I mentioned previously, actually the question in the survey is asking the experience of getting access to external finance in the past 12 months. So we denote SMEs free of credit constraint if they indicate the final outcome of loan application is will offer the facility they asked for, and they decide to take it as well. So as far as the presence of this is the presence of credit constraint is concerned, we take the following situations. Either any of the information appears, we are going to treat them as presence of a credit constraint. So you can see, actually, we not only take into account the answer which indicate their application was rejected, but also we take into account some kind of situation indicating the failure of cooperation between the bank, the main bank, and the borrowing firm. Okay, we aggregate them together as long as the answering belongs to either of the four answers, we treat it as the presence of credit constraint. So this is our mean variable, basically. It's a measure of strength of the relationship. We look at this question, okay, think about the relationship with your main bank. Which of options best describe your relationship with them? So we are going to label a value of 1 if the answer is we have a stronger working relationship with our bank and feel we can approach them whenever we do. This is indicating a stronger relationship with the main bank. And if the answer is the relationship with my bank is mainly for the transaction purpose, okay, or we don't have active working relationship with them, we treat it as 0, i.e. a weaker relationship with them. So we argue the benefit of using such direct measurement compared to traditional measure in the literature, i.e. duration of relationship and scope of relationship, because this measure could avoid the reverse causality situation. When I say reverse causality means, you have access to bank finance, then you feel your relationship with your bank is better. Okay, this is reverse causality. Or you feel, you are going to stay longer with your main bank. This is a particular reverse causality between the better access to bank finance and the long duration of bank borrower relationship. Okay. And also, we try to squeeze out the power explanation of relationship out of our measurement. We really want to look at a measure which closely related to the strength and the value of relationship. Okay. So as far as the control variable is concerned, the first variable we consider is a trust dummy. Actually, this is a dummy variable indicating self-perception regarding whether they are treated, firms are treated by the bank in a fair way. There's one question in the survey, ask them whether they believe or trust their bank has been dealing with them in a fair manner. Basically, the trust, we use this variable because, the literature suggests the trust level is lower if, the borrowing firm wish their relationship or economic transaction with the main bank should be handled using some subjective judgment. However, the bank actually adopt impersonal method to handle economic transaction with them. Okay, so we try to utilize this measure to avoid or capture such self-perception bias. Okay, and also we control dummy variable. This to capture the self-selection concern because the borrowing firm may choose a relationship bank or main bank on the basis of their expectation to be able to get access to bank finance. Okay, so we use the control variable to capture this bias, selection bias. Okay, also we have a bank credit type dummy. Here we have 2 types of bank credit. One is bank loans, another is bank overdraft. Therefore, you know, two types of bank credit will be different, you know, may not necessarily comparable with each other. In addition to this, different types of bank credit have different maturity. Maturity per se is a way of, you know, handling asymmetric information problem utilized by banks. Okay. Also, we control first-time borrowing dummy. This is inspired by the literature. You know, banks accumulate private information through, you know, learning by doing practice. You know, so first-time borrowing, you know, could has no such learning experience as far as banks are concerned. So we also, you know, control for exclusive min-bank relationship, because literature argues if there is multiple bank relationship, actually min-banks incentives to gather information and you know, work on the private information will be relatively lower, because there's a free riding problem in the case of multiple banking relationship. We control for the risk score, you know, categorical variables here. You know, this is related to probability of failure of borrowing firm, and we control legal form. Okay, because you know. Different firms with different legal forms actually subject to different degree of requirement in terms of financial statement reporting and information disclosure. We actually also control regional dummy, because different regions have different you know, characteristic in the financial development and the business environment. Finally, we control industry dummy. We try to catch the duration of cash cycle and the liquidity requirement for production, which is industry-specific consideration. So although I gave you a long list of control variables, however, I want to, you know, with our modeling strategy has been done through a specific to generous, you know, manner, i.e., we actually gradually increase the set of control variable in our model. So you can see it in the presentation of the result, which is following here. So I'm going to present the result right now. Just for your information, the estimation has been done, you know, using linear probability model. You know, yeah. We look at the result. You know, we found out as far as the whole sample period is concerned, relationship actually a stronger relationship does have the positive impact in terms of enhancing the likelihood to get access to bank credit. Just to recall, our dependent variable is free of credit constraint, means good access to bank credit. Okay, so we also found out a high level, that's just the second row of this result. You know, we found out a high level of trust of being treated fairly is associated with a higher access to the bank finance. Okay, and then the third row of the result indicate, you know, okay, here, let's say, compared to 1, 2, 3, 4, 5 row of the result, compared to medium firm, small firm has a lower likelihood of getting access to bank credit. This is in line with the argument because the smaller has a higher asymmetric information problem, because it suffers from a high degree of informational opaqueness. Okay. And then we found out, you know, the third line, we found out access to the, you know, bank credit improve in the post-COVID-19 period, okay? And however, you know, industry suffering from a high negative shock is less likely to access to bank credit, okay? This is our baseline model, okay? So when we look at the further examination, whether the relationship value will be different for the small firm versus medium firm, this is the result. Okay, we found out the relationship actually positive contribute to the access to bank finance. This value particularly pronounced, particularly valuable, or stronger for the small firms compared to medium firm. However, this is a whole sample situation. Okay. Then we start to look at whether in the post-COVID-19 period, the relationship value becomes stronger or weaker. Okay, so we found out the impact of relation on access to bank credit decrease in the post-COVID-19 period compared to pre-COVID-19 period. Okay, you can see as far as other variables is concerned, basically more or less very similar to what presented in the previous slide. And another one before the previous slide. So I just concentrate my discussion on the part of result which highlighted in red. Okay, so we further look at whether such decrease in the value of relationship on access to the bank finance differ for the small firms versus medium firm. We found out the diminishing impact of relation on access to bank credit in the post-COVID period actually does not appear to be different for the small firms versus medium firm, i.e. actually the value decrease and such decrease in the value of relationship appear to be uniform for the small firm and the medium firm. Okay, as far as other variables are concerned, the result are more or less similar. In addition, as I mentioned, we built up the model from a specific to general setting. We gradually enlarge our specification of the model. The result are very consistent. Okay. Now I'm going to present the final result. We look at whether industry suffer more negative shock, benefit from the relationship, stronger relationship in terms of getting access to the bank credit. Actually, we allowed all the variable appear in the model and then to have a separate look the impact of relationship for the industry which suffer larger shock and compared to that suffer a smaller shock in the COVID-19 period. In the post-COVID-19 period, we found out impact of relation on access to bank credit decrease, which is always like this. So just to remind you, and also the impact does not change. Decrease in the impact actually has no difference for the medium firm compared to the small firm. Okay. However, we found out as far as the decrease. Diminishing impact of relationship on getting access to bank finance for the firm which operates in the industry suffering high negative shock is concerned. There's a slight, there's a value here. We can say it's positive, all right. So relationship banking positive, however, the impact actually decreased in the post-COVID-19 period. However, the impact slightly, reverse back for the industry which suffer high negative shock in the COVID-19 period. Okay, so we done the mean analysis. We estimate all the model, using linear probability model. Okay. Also, we built out the model from a specific to general setting. Our result hold. Okay. So we re-estimate all the model following the same practice. Now we use probate model. Okay. In addition to this, we consider self-selection into the credit application process. Okay. We jointly estimate demand for external finance plus the outcome of the application of bank credit from their main bank use Heckman selection model, basically by probate. Our main result are qualitatively unchanged. Okay, now I'm going to repeat what we found and also present policy implication and explanation of the empirical result. What we found the relationship banking is important for the acquisition of bank credit in the pre-COVID-19 period. However, when we look at the post-COVID-19 period, it seemed to become a very little impact, positive impact. Okay, if we put this result in an alternative way, actually banks treat small medium firms that have a stronger relationship with them in the same way as those that do not have in the post-COVID-19 period. Okay, so the second main result is we found that the impact of relationship on small firms is stronger relative to that on medium firm in the pre-COVID-19 period. However, it's not the case when we look at the post-COVID-19 period. Put differently, the diminishing impact of positive value of relationship on accessing bank finance appear to be uniformly applied to small firm and medium firm. Okay, so although relationship banking seemed to play a very little part in the post-COVID-19 period, however, we found out small medium firm operating in the industry suffering more significant negative shock because of COVID-19 appear to be treated better. Okay, we show the value reverse back as far as this particular group are concerned. Okay, industry specific shock. So how we are going to explain the result? So when we look at the literature, let's just repeat those interesting words. One literature talk about the true love means I'm just the value will remain regardless good time and bad time. Okay. Second literature talk about this Fairweather friends means I'm helping you as a friend in the good time, but I'm not helping you in the bad time. Okay. The third part of literature talk about dark side of relationship means when you are in trouble, I even abandon you. Okay. So what we actually found out, okay, just to repeat, we found out the diminishing positive impact of stronger relation on the access to bank finance in the post-COVID-19 period. Okay, we found out a more pronounced effect for small firms compared to medium firms in the pre-COVID-19 period. However, it does not matter anymore. No significant difference between those two groups in terms of value of relationship in the post-COVID-19 period. However, we found out the stronger relation does have value as far as SMEs which operate in the industry suffering larger shock because of COVID-19 shock. Okay, so apparently we are not in the category of true love. Okay, we are not in the category of dark, side either, because although diminishing, okay, however, we can only seeing in the post-COVID-19, we are only seeing not become stronger rather than not exist at all or become even worse. Okay, toward the opposite direction. So it's not negative impact or dark side of relationship. So how about this Fairweather relationship? Okay, does not seem to be, because we treated stranger in a similar way as friends in the post-COVID-19 period. It does not indicate I am like abandon my friend at all, Also, the third main result, we found out some value as far as those who are in the deep, shortage of cash flow, because industry shock as a result of COVID-19. Okay, so the strong growth in the credit availability. So how we interpreted the result, we believe there's a reason for this, which attributable to the government action intervention during the COVID-19 period. When we look at the UK situation, government intervention during initial stage of COVID-19 period is very fast, also very generous. The strong growth in the credit availability initiated by the government authority. So actually, such intervention, actually has been done through the private banking sector. Actually, lead to the failure to discriminate the value of relationship between normal and abnormal time. Also, lead to the failure to discriminate the value of relationship between closer friendship versus a weaker relationship. Okay, in the post-COVID-19 period. Okay, so the idea we try to sell you is when the lifeboat is large enough to rescue both friends and stranger alike, the value of relationship become insignificant. Okay, so when there was a size of lifeboats runs on a so soon for the larger negative shock, i.e. the industry shock, actually, is very large despite the generality of the government intervention. The value of stronger relationship restores. This explains our result. We found out firms operating in the industry which are suffering from larger negative shock because of COVID-19, we see the value start to come back. Okay. So policy implication, our evidence actually suggests the value of UK government intervention toward small medium firms in close relationship with banks and those has not enjoyed such a relationship previously. Okay, so our result indicates the value of stronger relationship, also indicate the government intervention and stronger relationship with the private banking could be implicitly cooperative. Okay, this is my presentation, and I'm welcome your question and comment.
Thank you very much, Tianshu and colleagues. I can see to establish the true friendship for the banking sector between the banks and the small firms. The presentation is very clear, has drawn upon very interesting literature, used plausible models, and absolutely interesting conclusion and findings, and very contemporary to this, see the effects of COVID. Let me ask to see whether Kent would like to add something. I can also see good old friend Max Munday in the, I can see in the audience, Max. If you, either Kent or Max want to add something, or we go straight to the feedback.
Actually, I have nothing to add. I think Tianshu did a good job in explaining the guts of the paper. I think it's worth reiterating the policy conclusion, because although Tianshu made the case that there's a case for an implicit cooperation between governments and the private banks, one has to remember that this is a special case. I mean, COVID doesn't happen all the time, and just because governments and banks appear to cooperate very well in times of crisis, it doesn't necessarily mean that they will go and cooperate in normal times. And the other thing that I want to emphasize is that, when you have when you don't face the same budget constraint, you can make different choices. One is reminded of what Molière said about friendship. He said, the person who is a friend to everyone is no friend of mine. And what he was saying is that because there's a budget constraint, if you're a friend to everybody, you can't give to everyone. You give less. But in fact, in the case of COVID-19, the government largesse was so great, they were able to give to everybody. And therefore, you didn't have to discriminate between those who had a close relationship with the bank and those who didn't. everybody got, something, and therefore that's why that post-COVID gives that kind of result.
Thanks very much, Kente, for that giving extra clarification. Absolutely helpful. Max? I saw Max around. Do you want to unmute? Okay. I'm not sure whether Max is still around, but let's go straight to questions. I can see hands up. I can see Matthew Zhao. I can see George, and then Hongbo. So let's go in that order. I'll start with the Matthew Zhao.
Hi, thank you. Matthew Zhao here from the IFC. Were you able to control for lenders who were not part of government programs? In other words, part of your attribution here is that it was a government tide that was lifting all ships regardless of relationship. It's also possible that the discounting of prior relationship was a recognition that the past no longer is relevant given the structural break, different industries affected different ways, lack of visibility to future earnings depending on waves of pandemic and so on. So, it would be interesting to understand whether that result is primarily because of the government, or were you able to look at some lenders who were not using government funds or government support, and whether they continued to maintain importance to relationships or also dropped that historical data element?
Thank you, Matthew. Would you have to respond to that before we proceed?
Okay, because the survey has no information regarding whom the firm borrows from, but we do go through the BBB website or other policy intervention website. We check who are the participating banks in the government sponsored program, financial intervention program. UK has very unique banking structure because the major British bank contribute 80% of SME lendings. So when we look at those, website, we see the names of participating banks. Actually, all the major British bank take part in, government initiate financial support. There are the other small banks also take part in. So we believe we cannot say we catch 100% of this supply side, but we actually could at least catch like 95 or 80% coverage of participating bank, in our analysis. Yeah.
I'm actually looking at it the other direction. Could you separate those in your analysis who were participants and those who were not participants in the government program, and then see if there's a differential in the value of relationship?
Yeah, this is, we need, in this case, we really need like a name of main bank. We are not able to have this information.
I see.
Yeah.
Okay. Thank you, Matthew, for that, and thanks, Tianshu, for response. Next is George. It seems George has dropped.
Yes. Hello.
George. Okay, go ahead.
I'm on. Hello. Thank you
Yes,
very much, Victor. Yeah, I would like to thank the presenter for the wonderful presentation. And this is really very good for studies related to financial inclusion, because when you look at most of the previous studies, this seems to be among one of the most recent study trying to bring forth what could happen to financial inclusion under a situation of pandemics. And this is really very, very critical. I have a few points that I would like to share with the presenter. First of all, I would like to thank the team for including the element of trust, the trust control variable. However, there are a number of suggestions that I would like to make as far as the control variables are concerned. One of them is the time factor. For how long have these SMEs been the customers or borrowers or clients of these banks? That would really also be very important because the time matters within the relationship. And then also, I would have also suggested that the team would look at the type of ventures, because you see we have the SMEs, but what type of particular businesses are these SMEs engaged in? For example, you will find that the SMEs that were, of course, selling like we have those dealing in consumables during the COVID pandemic, because you find that most of these MSEs would have been selling probably foodstuff and other consumables to the people. So you would find that it is very critical to show, because I expect that.
Yes, George. George, we may possibly have connectivity challenges. George, possibly George has been cut off. Apologies. He was making good points, and maybe he will come back to us and complete the question. So in the meantime, let's move to Hong. Hong, could you please unmute and ask your question? Yeah.
Yeah, okay. Thank you very much, Victor. Sorry, my voice is still not that very strong. And thanks for the presentation as well. So this is a paper about COVID-19. I feel that I did not see, I would like to see more of COVID-19. So it's, for example, we review the paper, we see this type of papers even in the normal circumstance. So what is the tension caused by COVID-19? And you started by mentioning the literature of asymmetric information, and that is the traditional problem for small and medium-sized enterprises in terms of their financing. However, COVID-19 is different from, for example, the last financial crisis. Yeah, because think about 2007 and 2008, the problem occurred initially in the credit market. So the asymmetric information immediately emerged because there is a shortage of supply of credit. This time, the situation is different, the problem is different. It is a shock to the real economy initially. And there is no shortage in terms of the credit market. I do not believe that banks, they are facing shortage of money to give people, to lend to people. And in fact, it is the other way around. They have money, but the real sector was affected so severely that they cannot really run their normal operation. So I think the situation is different. I'm the person who wrote a dissertation combining capital market imperfections, i.e. asymmetric information, and uncertainty. And you do mention a lot of shocks, etc., etc. So I think this is at the end of the channel, it is probably the uncertainty problem rather than the asymmetric information problem. So I would, if I were you, I would consider, I would start with the shocks, with uncertainty to the real sector, and how it affected the balance sheet of firms. Therefore, that will be transferred to the credibility. Okay, and that then you can link to the asymmetric information problem. So that's my first concern. And secondly, so by doing that, I think you can emphasize more of COVID-19 rather than, the bank and firms relationship, because otherwise, it is normal. It is, you have heard of this type of things so often and so much. And my second point is, in your methodology, probably you can consider using DID, and that can give you the opportunity, difference in difference, and that gives you the opportunity to emphasize on COVID-19. And also in your current model, you added a trust, and your key independent variable is a relationship. And then in addition, you added trust. To me, they are the same thing. So if you have a good relationship, a long-time relationship with a bank, you trust with each other. So basically, I think there is a correlation problem for that. And lastly, in terms of COVID-19, yes, you mentioned the policies, but I think you really need to control something in this respect. The previous comments already touched upon, the banks who participated in the government program. But I would say for the firms, small and medium-sized enterprises, they got a lot of help from the government. So I think that is very much relevant to how much they need to borrow or how much, they can borrow. And so things like that. So that's my, I think maybe three or four comments, but well done. It's a very updated topic and a very interesting start. I mean, given the limited data you have, you already produced a very interesting paper. Thank you.
Thank you, Hong, for those detailed comments. Maybe we could ask the authors for a response, discussion, feedback on this.
Let me answer Professor Hong's comment first. Then if Kent Matthew want to add anything on, okay. Okay, actually, Hong, we are actually exactly on the same page, okay. As far as uncertainty part is concerned, this is also the reason why we actually really like the industry shock story, because the industry shock, if you read the paper look at demand shock plus supply shock, in addition to consider input factor, input materials through supply chain. So although we eventually just separate the shock into stronger and weaker, however, the economic foundation is very thorough. It's also good measurement because that it does not suffer from the endogeneity, because if you look at like a revenue decrease and so on, that is outcome of this COVID-19. But we look at the capacity they can work at home and whether they can get input factor, on time, or whether the customer is willing to purchase the product they produce and so on. Actually, this is the first thing, actually I concur your comments significantly. Okay, we didn't think about this is asymmetric information, but rather is in need, friend indeed, it's a friend in need kind of, all right. Okay, and the second comment, you said you believe this is a shock coming from a real sector, which we agree, we cannot agree anymore. Basically, this is when we look at the result, we kind of feel how come this result with three others have different explanation of the result, basically, and then we dig deeper to look at the UK government support compared to US government support and so on. This is we eventually think maybe is more relevant in terms of explaining the result. Also, giving the data is very short. We hope to have larger, better data set or have longer, like after COVID-19. We are not able to go that direction, which we are going to continue to another paper for sure. Okay, this is the second thing. And also, in addition to this, just also, reply the thing I just answered about the first, audience inquiry. Because the UK government actually, in order to enhance the efficiency of government, intervention, all the government intervention is done in the partnership with the private bank, basically. So also, therefore, although they apply the bank credit from private bank, basically, government provide 80% guarantee, interest income plus principal and so on, actually. Therefore, we feel maybe this is the main reason driving our result. Yeah. What else? Trust. Yeah, trust. Actually, the question is whether you believe your bank trusts you fairly. Okay, I believe the literature basically also talk about the demand for relationship from borrowing firms' perspective, i.e. some small medium firm demand for relationship banking, some does not need it. So as a result, whether they feel they are treated fairly or not really depends on whether they want it or not, or like we are children, if we want the parents like give us a lot of money, we will feel, having a large amount of money from parenting is good treatment. If we don't want it, we are independent children, we don't think it's fair. So it's not trust per se. It's are you believe you are treated by your main bank fairly? This is a very interesting point because I read some literature. They are talking about like if you expected things like this, you didn't get it, you will feel unfairly treated. I.e., if you really want a relationship banking, you didn't get it, so you feel you're not fairly treated. Like if the risk can be priced properly, I'm willing to pay a high risk premium to get access to bank finance. If we talk about it in the economic setting, I think it's a very interesting idea. I really happy you point this out as well. We initially feel maybe it's trust. We actually want to utilize as an alternative measurement of relationship. Then we read the survey again. If you can read the survey, we realize, this is not what we initially want to use. Anyway, okay. These are all my comments, all my reply toward your comments. Thank you very much.
Thank you, Tianshu, for making the responses and appreciating the comments. I think also like the comment by Hong on introducing uncertainty, focusing on uncertainty issue, beyond the focus on information asymmetry, except I'm trying to work out in my own mind, given the known measures of the empirical measures of uncertainty, how we could now capture uncertainty in the COVID situation. I think, of course, one could apply the known measures, but these measures capturing uncertainty, in the literature when, COVID was not an issue, COVID becomes an extra important dimension. But then how would we separate the uncertainty that arises from normal business transactions from the uncertainty due to COVID? So that would be like compounding, the degree of uncertainty and trying then to isolate the uncertainty that may be facing firms or facing, the borrowers, and separating that from the normal certainty that we normally measure that arises from financial transactions. So I suppose that gives the rise to a broad agenda, and sure I can see Tianshu, Kent, and Max preparing for another additional paper in extension to this, or maybe with Hong, who knows? Yeah, I don't know whether, Kent, you have any observation to make. Feel free to join in if you wish to.
Not really. I mean, I just want to comment on what Professor Hong said. I think she's absolutely right. And you've just said it again, that uncertainty is the strong element here. But that doesn't mean to say there isn't sufficient heterogeneity, that asymmetric information has disappeared. But you're right, it's uncertainty that's the dominant feature. But having said that, you know, I mean, the point that Tianshu made about the underpinnings of relationship banking might well be asymmetric information, but once that's solidified, once that's cemented, it's the issue of a friend in need is a friend indeed. And that issue was actually examined in a much smaller, a modest paper we did for a survey for Wales, where we looked at the value of relationship banking. And there we found that in times of need, relationship banking mattered, and that firms were willing to pay more for that. It was like an insurance policy in times of need. And so that was the question, really, that we were really asking this question in relation to a paper by Berger and others who examined this in the US, and they found a dark side to it. We found that given the largesse of government, there was no need for a dark side. You know, when you have a large budget constraint, you can be a friend to everyone.
Yeah, yes, thanks you. Absolutely interesting. Is George back? George, if you're back, you could continue your question. I'm just chatting to see whether any hands going up.
Hello?
Yes, George, yes.
Yeah, sorry, I had a problem with my internet connection. So what I was trying to say that it would be better for the paper to have a control variable on time of the relationship with between the SMEs and the bank. And also, I don't know the type of banks the authors are looking at. Are they development banks, commercial bank, cooperative banks? So that would again bring a gooder picture of where the SMEs borrow most, especially within the context of the UK. And there was one point that I was trying to bring on before I went off. That is the type of businesses that are actually most of these SMEs are engaged in, because you will find that we have the production MSEs, and then the non-production SMEs, like the consumables and non-consumables. So is it the same kind of all these SMEs experiencing the same kind of limited or non-access to bank credit? Does it depend on the type of the business venture the SMEs are engaged in under this kind of shock? So it actually brings out a better conclusion, because then the paper can conclude that generally the SMEs that are engaged in the different types of businesses or specific type of businesses are denied loans by the banks under this kind of shock. And then also, what came into my mind was you find that, for example, in Africa, the SMEs have what we call ownership. We have ownership structure where you find some kind of partnership and then sole proprietorship of the enterprises. Does that in a way also affect the kind of access to credit in this kind of relationship? That would also bring out some good argument. And then finally, I'm wondering if these SMEs were borrowing, for example, credit from the banks, what kind of borrowing were they? Okay, the remittances of the fund, do they use some sort of digital finance in this kind of credit when they are seeking for credit, and then the banks, for example, do some kind of remittances to their different bank accounts? Because you find that under the pandemic, most of the banks were operating through what we call internet banking, mobile banking. So what kind of banking structures, banking channels were being used by these banks in remitting the credits to these SMEs? And then also, I think there were several kinds of pandemics before the COVID, like SARS and all that. What were the situations in this kind of previous pandemics that hit the world? So that there could be some kind of comparative analysis between what happened previously, like during the World War and all that. What were the behaviors in the previous kind of shocks and this one of COVID? So it would be better for the paper to try to link back to create some kind of debate on what happened previously to the SMEs, and then within the 21st century when we experience this kind of shock from COVID. So basically, these are the few remarks that I have on this presentation. Thank you very much.
Thank you very much, George, for those comments. Tianshu, do you want to respond?
What I catch so far is George is concerned about some industry feature or firm-specific feature in terms of demand for credit. We didn't, consider, or we didn't consider some very specific bank borrow duration, relationship duration, and so on. Yeah, I think those are the two things George seemed to concern the most. In terms of, the first part about firm-specific shock, we actually we use the industry as a way to capture it. Of course, you can argue actually, firm within industry there's a specific, heterogeneity across the firms. We control some like characteristic of firms. Maybe not enough, but anyway, this is what we did. Okay, in terms of like duration of bank borrow relationship, and other features in the bank and borrowing firm are concerned, because we don't know the name of the main bank, so we cannot do very much. However, we do believe, because the question is very straightforward, you hardly can make a mistake. Ask you what kind of relationship you have with the bank. Okay, so I think it's more straightforward compared to duration and other types of measurement which used by the literature. Because look, we did another paper I did with Kent. We found out the duration does not matter. Like the quality of marriage is nothing to do with the duration of marriage. So we feel it's perfectly makes sense. Okay, I think we think the and the straightforward answer seem to be better compared to others, which imperfect proxy for this relationship tightness between the bank and the borrower. Okay, therefore we kind of feel more confidence in terms of the question mark regarding the shortage of knowledge of specific bank's name in this story. Okay, but we didn't control much about except for industry shock, we didn't control much firm specific shock resulted from COVID-19. That is true. Yeah. Also, I reflected to the first audience question. We didn't know how many main bank are not participating into the government program either. This, we cannot do much about it. Yeah.
Thank you very much, Tianshu, for the response. Yeah, Sola, I see your hand up, and please go ahead and unmute and ask. Give your intervention.
Thank you very much. Sorry, I couldn't put up my hand in the chat function for some reason, but just to say thank you, Tianshu, for this presentation. I found it very insightful. And even though it is a UK context, my experience is across sub-Saharan Africa. And I did sort of try and sort of reflect on if this was done, if this research was done in sub-Saharan Africa, what will the outcome have been? Because I think relationship banking is more than credit. I do know that credit is an important aspect of that relationship, but really, particularly through COVID, my experience, and I worked for a Pan-African institution, was that there were other aspects of the relationship that were quite important. It came to advisory, giving fee waivers, moratoriums, restructuring, and like Professor Hong had mentioned, the supply chain disruption was really very important. In fact, at some point, we had to assist some of our SMEs to link them up with suppliers just because of the disruption. And they found that much more useful, than just giving them money. So I just think it's a point which might already be captured in the paper, that the relationship is more than just money, but it's something to bear in mind. But I think it was an excellent paper, and thank you very much for sharing it. Thank you.
Thank you very much, Sola. Sola comes from a very rich background of having been CEO of the Pan-African Bank Standard Chartered Group, as he was saying.
Standard Bank, not Standard Chartered, Standard Bank.
Standard Bank, okay, Standard Bank, yeah, which is different from Standard Chartered. Yes, I do appreciate it, yeah. And yes, thanks very much for sharing that insight with us. I think we'll possibly have another conversation on some of the details together with Kent and Tianshu and Max later on your experiences and the work that they are doing, which is absolutely brilliant. Thank you. There is a hand up from Beniamino Savonito.
Yeah.
Please go ahead.
Hi, and thank you for the presentation. I'm also listening in from the IFC from the US. Really interesting research. I was wondering if I could clarify. Right now, you're only able to control for a dummy on the intensity of the impacts of the economic shock on the SMEs. I'm wondering whether by trying to, if you were able to access information that would be more nuanced on that, and perhaps looking at some volatility index or other measures or proxies for how uncertain the outlook of the business for some of these sectors might have been, then that might actually help you to rule out the, I think, one question that is emerging from the comments, which is whether just simply the magnitude of the shock was such that the relationship data, the data that was coming from the relationship, didn't quite matter as much, which I think would maybe lead to a slightly different set of conclusions, one that would probably also extrapolate to a country that didn't have as rich of a set of interventions as the one that the UK has seen, where you might have actually also see the same dynamic happen, where essentially the real sector impact are such and the uncertainty impacts are such that it just flattened or diminished the importance of the relationship, no matter on how much other help was going on there. So just a suggestion.
Thank you very much, Benito, for this suggestion and for participating from the US at a very somewhat early hour, early morning. Thank you, much appreciated. I don't know whether you need to add anything, Tianshu or Kent, in this, apart from appreciating the comment and the suggestion made. Yeah, okay. I think I note some messages coming from Richard Alexander. You have any comment to make? I can't find you in the chat. Richard, if you are still around, please unmute. Richard? Is possibly gone. Meng, can you see some comments from Richard? I see some flip-up message coming on, but I can't find them in the chat room.
I don't know if you've already covered
the comments.
Yeah, the previous one.
I cannot. I don't see the comments in my version of the chat. Any comments you can see?
Yeah.
Okay, go ahead.
Yeah, from Richard. So
okay.
The two forms of no relationship are quite different. The first could suggest that the bank would be interested in lending to the firm if the firm wanted it, and hence the firm regarding them well. The second suggests the bank wouldn't. Does that make a difference to the level of trust?
Okay, thank you. Thank you, Meng. I think possibly Richard has left, but is that something you want to respond to, Tianshu?
I think Richard also put another comment. When I answer Professor Hong's inquiry about trust, yeah, I think I already somehow, actually conquer his idea. He tried to help me to explain, the economic meaning of my trust measurement, I believe. Yeah.
Okay, I appreciate it. So that's as giving another interpretation to the results, which is absolutely helpful. Okay, I don't see any other hand up, any other comment. So maybe what remains for me is to appreciate much profoundly the discussion that you have unleashed, the sensitizing us to the type of relationship on relationship banking following the under the COVID-19 scenarios, and provoking ideas and debates on how to take this forward, or maybe even scale up the investigation or go deeper and look for further data. I think this is all exciting discussion, especially as we all look into the post-COVID economic recovery programs. I think the nature of the discussion for this seminar is likely to be followed up by a number of interesting discussions and maybe questions, and we shall make the paper available when it is reached the stage of being circulated, and then we can be able to continue the discussion, and maybe then on that basis have further research. This is an interesting idea that would be of interest not only to researchers, to governments, to SMEs, and to financiers, including banks. So thank you very much, Tianshu, Kent, and Max, for starting off a very interesting discussion that indeed is likely to go on for not only this year, but maybe a couple of years to follow. Thank you indeed, much appreciated. We give you a hand of applause for this work that you've done. Thank you indeed. Okay, so this is the end of the, yes, indeed, you can see the hand prodding there electronically, okay, digitally. We'll be meeting here and we'll be sending you a coverage, including the messages that have come out of this meeting. Already, there is a lot of social media coverage going on, tweeting, especially on this seminar, and then we'll send you the invitation for the seminar next week. The series, the set of seminars, the lineup of seminars for the whole of the academic year until June 2022, this is available on the website of the Center for Global Finance please do visit the website, and you can be able to look at the selection of papers, and where you can come in and participate as we explore interesting dimensions and follow the interesting research that is done by colleagues and the family of our researchers. Thank you indeed, and I see you here next week. Thank you, and bye-bye.